double entry system and golden rules of accounting. Double entry system. Double entry states that for every debit entry, there should be a matching or equivalent credit entry, or that for every credit entry, there should be a comparable or like debit entry. The system of debit and credit is right at the foundation of double entry system of bookkeeping and accounting. The duality or double entry concept insists on the actuality that every solitary transaction has a double or dual effect on the position of a firm as recorded in the accounts. Every financial transaction behaves in this dual way. Golden rules of accounting. Golden rules translate convoluted or complicated bookkeeping rules into a set of principles which can be easily learnt and put into operation. When recording transactions in the ledgers, certain golden rules would have to be applied and strictly adhered to. The golden rules of accounting dictate that one determines the type of accounting question. Each account type has its rule that needs to be applied to account for the transactions. One would need to know the different types of accounts. For one to correctly apply the golden rules of accounting almost all the time, they would need to grasp the different types of accounts, which include and may not be limited to the ones specifically highlighted. Personal accounts are the accounts that are related to an individual, a company, a firm, or a group of associations, and so forth. These persons might incorporate or combine natural persons, artificial persons, or representative persons, as the case may be. Real accounts are those accounts that relate to assets, properties, or possessions. These related properties might exist in physical or non-physical form, goodwill, patents, etc. Nominal accounts are those types of accounts that are related to any form of income or expenditure, gain or loss, for example, rent, salary, and wages, and so on. Golden rules of accounting. Debit the receiver and credit the giver. This golden rule is applied when dealing with accounts of individuals, that is, personal accounts. On one hand, debit assets accounts when they are increasing. For instance, when a business acquires a non-current or fixed asset, the non-current or fixed asset should be debited to show the increase. On the other hand, credit assets when they are decreasing. For example, when a firm disposes of a non-current or fixed asset, the non-current or fixed asset account should be credited to show the decrease by removing what would have been disposed of. Take note that real accounts involve machinery, land, and building, and so forth. Although liabilities accounts are credited when rising, they should be debited when dwindling. For instance, when a business experiences an upsurge of a liability, it should credit the liability account, whereas when it settles the liability account should be debited to show the reduction. Debit all expenses, purchases, and losses accounts when they are increasing, and credit them when they are decreasing. Credit all revenues or incomes and gains accounts as they rise, and debit them as they fall. When it comes to capital and equity, these should be credited when they are increasing and debited when they are decreasing. Drawings are debited when they are rising and credited when they are declining. Thank you.